Financial accounting has always dictated how to value inventory and calculate product costs. And for good reason. Standard costing, the method used for financial accounting, is easy. Everybody learns it in their accounting courses. Every general ledger software does it, and we all understand it. This easy button is truly easy. So, if you must use the easy button for Wall Street, the bankers, and regulators, why not use it for internal decisions, right? For example, when making decisions about products or customers, what's not to love about a universal easy button? Unfortunately, the information produced by standard costing significantly compromises internal decision-making. Now, you might object to the harshness of this criticism. Standard costing is a trusted method used by so many for so long. However, keep in mind, we are talking about two very different worlds here. In one world, we have the aggregated historical financial information compiled for external use and not for the purpose of running daily operations. Sort of like the role of a corpse in an autopsy. In the other world, we have a real living, breathing, running business that requires constant decisions to keep it going and homing in on its stated target. The diverse information needs of these two worlds informs our criticism of financial accounting costing information. Here are 6 examples of the problems with using easy button information for internal decision support. Number 1. The data is not causal. The easy button operates based on a totally different set of principles than what is required for effective internal decision support. Financial accounting adheres to the matching and periodic principles, which do not provide managers clear cause and effect insights to guide their analysis, extrapolation, and logical reasoning in the decision-making process. Number 2. Standard costing allocations. Traditional standard costing is famous for its percentage allocation of operations overhead. This practice spreads too many costs to high-volume products and too few costs to low-volume products. Number 3. Hidden idle resources. The easy button also hides idle or unused resources. Idle resources have nothing to do with the products actually produced, but the easy button nevertheless spreads these costs arbitrarily to current production, further distorting the information necessary for good decision-making. Number 4. Information stops at finished goods inventory valuation. Standard costing does not include any product costs beyond production and placement in finished goods inventory. Product costs excluded are customized services, different channels costs, and distribution and warranty costs. Companies with these offerings in their go-to-market strategy need anything but the easy button. Number 5. Variability for cost behavior. This works fine as long as you make only one product, for instance, Model T Fords. In the 21st century, products and services are customized. The product portfolios are a blend of technologies with more complex and less complex products. Products with different complexities consume variable factory overhead in different patterns and proportions. When it comes to cost behavior, the easy button has no clue about the actual marginal cost of a decision to change output. Number 6. Very little predictive capability. When a cost model does not reflect actual cost behavior, it cannot be used in predictive tasks or to enable the crucial managerial activities of planning and simulation. As you can see, the easy button simply cannot satisfy internal decision support needs. In corporate America, this realization has been a long time coming. But the extent of these shortcomings weren't fully recognized until the accounting community recently adopted a set of principles for management accounting for the first time. The principles of management accounting open up a whole new world in the areas of decision support and execution optimization. For example, do you want to know your most profitable product or service mix? Would you like to generate next year's budget by running your planned sales through a cause and effect costing model? Better still, would you like to know the avoidable costs for any decision you face? These principles have enabled Altavia to introduce a set of artificial intelligence tools that answers these and other pressing management questions. Leave the easy button where it belongs. It has a legitimate function in financial accounting, but that does not include the requisite support of internal decision-making. Talk to us on how to consistently achieve optimal decision outcomes and leave your competitors to fumble with the easy button that couldn't.